Hello and welcome to the next installment of Diversified's monthly video series. My name is Mike Horwath. I am the Chief Investment Officer here at Diversified. I want to take a few minutes and talk about living and investing in volatile times in markets. I don't think it's any surprise if I told people that markets are down this year. I don't think it's a surprise if people have felt a little anxious because of the volatility. But I think it was important that we take a step back and we give our perspective and we give really our thoughts on what's changed in markets and really the silver lining behind everything. So many of our clients are conditioned and they always respond with, I know, I shouldn't be worried about markets. I know, we'll keep a long-term perspective. And all that's true, right? That's tough, and I'm proud that we've really conditioned our clients to understand and believe that and believe in that long-term perspective. But I want to take a few minutes and really hammer home why we believe that's important and why we believe that while we say do nothing in some sense, we don't necessarily mean do nothing or that we're doing nothing, because I think there's a big difference between keeping a long-term perspective but then using this volatile time to be proactive in certain areas. So let's talk about that for a few minutes. So we'll go through a little bit about our perspective on equities. We'll talk a little bit about valuations. We'll talk a little bit about market sentiment. I think that's important. That's something that doesn't get spoken about too much. And then lastly, what are some opportunities, right? What are things that we're taking advantage of during these times? So first and foremost, I think this is really what we always go back to. Equity investing, so investing in stocks, is a long-term endeavor. In short periods of time, investing in the stock market is just a roller coaster. That's true of this year, it's true of 2020, it's true of 2018, it's true of many periods over the last 40, 50, 60, 70 years in markets. Equity investing works because you are investing in the growth of businesses and the growth of the economy here within the US and within really any economy globally. You are investing in that success and that growth over the long period of time. In the short term, things happen. Countries go to war with other countries. Interest rates move up and down. Inflation goes up and down. Governments do things that they need to do, right, to balance budgets, or to elections happen, or pandemics happen. Things happen in the short term. Over the long term, we believe in the growth of economies. We believe in the growth of quality businesses, right? Businesses that will grow and evolve over time, and technology that will grow and evolve over time. The only way to consistently get that return in equity markets is to actually be invested. Sitting on the sideline waiting for markets to go back up, unfortunately, it's just a losing battle. Becoming more conservative as markets fall and becoming more aggressive on the flip side as markets rise is just a losing proposition, right? You're doing the opposite of what you should do. The best way we know how to make sure investors get rewarded for the risk that comes with stocks is to keep them invested in stocks, right? It's that simple. So as an equity investor, we have to just know that we are focused on the long term and that they are risky. They've always been risky, right? And that's why they return a higher percentage than cash and bonds, because they carry higher risk. So by staying invested and by keeping that long-term perspective, we're making sure that our investors and our clients are reaping those rewards over longer periods of time. The other thing I would really focus on is, while things feel more challenged right now, and they've been, right? We're faced with a whole bunch of different variables that are creating uncertainty in markets. The good part is that markets are much more attractively priced than they were 6 months ago. We always talk about how expensive stocks were, call it 6, 12 months ago, after they had this really strong run up, right? Stocks became more expensive and markets were willing to pay that when interest rates were very low. But what we've seen over the last 6 months and what we're showing on the screen is the price to earnings ratio of the S&P 500 equities. And what you've seen is this big reversal in the valuation. Stocks are much more attractively priced. It doesn't mean that they're extremely cheap, but it means you're not overpaying and you're getting at a much better value in equity markets than you did a mere 6 months ago. Most of that's driven by prices coming down, but earnings remaining, at least earning expectations remaining pretty strong moving forward. Obviously, this can all change. This is all fluid. But as investors, when you're looking for values, relative to where you were 6 months ago, entering the market now is a much better proposition than it was at that time. Another really important thing is historically when we look at market sentiment, there are organizations, the University of Michigan being one of them, that does consumer sentiment surveys. And these surveys measure how consumers feel about the market. Typically, they ask questions about whether it's a good time to buy a car, a good time to buy a house, or a good time to do this, or what do we expect inflation to be? And what they try to measure is how consumers feel, right? Because that's one aspect to consumer spending being 70% of the U.S. GDP. Consumers have to be willing to spend the money, not willing to just stash it or stop spending because they're worried about losing their job or something along those lines. One important facet to this, though, is historically when we've seen consumer sentiment trough, right, at its worst, the market performance over the next 12 months has historically been substantially better on average than when sentiment has peaked, right? Same idea when markets feel their worst, it's probably a time to dip into the markets, right? We always like that Warren Buffett saying where, you are greedy when others are fearful and fearful when others are greedy. Well, we saw consumer sentiment surveys recently that have been at historic lows, right? People are just worried about inflation, higher rates, just all the noise in markets. So what we advise people to do is to take a step back and just look at the numbers and look at how things feel. And while we're not guaranteeing the next 12 months are going to be close to the average, right? We can't guarantee that. But we just have to understand where things are in relation to where they have historically been and what's happened in those scenarios. The last thing I would point out really is that we need to take advantage of what's happening in markets, right? Even though we're focused on the long term, it doesn't mean we don't do anything and that there's not opportunities to take advantage of market volatility and market downside. First, you can be proactive. You can make proactive portfolio changes. We made one late June, right? We're making one, we made one back in April. We made one back in January. We make our strategy changes quite frequently. We're always evolving how we're looking at markets, and they may be smaller tweaks to market or to portfolios. They may be bigger changes. But at the end of the day, we're trying to always be proactive. It doesn't necessarily matter what just happened. It matters where we are, and where things are potentially going, and what we see is going to happen. So being proactive, both on your equity and your fixed income portfolios, can really be a good opportunity, especially during choppy markets when things are becoming a little bit more emotional rather than fundamentally driven. We can also tax loss harvest in volatile markets, especially to the downside. So what does that mean? It means in your taxable accounts, we can sell securities that are at a loss and harvest those losses to use to offset future gains or to help offset income on tax returns. So that's something that we've been very proactive with early in this year. Sometimes people wait to the end of the year to see if there's any losses. Well, if markets are choppy or volatile early in the year, you should probably take advantage of that. That's something we have been doing, and we advise that investors look to do that when markets pull back. Harvest losses, we know that when markets are very strong, taxes and taxable gains can be a little bit higher because you're selling things that everything has appreciated. While on the flip side, we can harvest losses and use that to offset future gains. And then lastly, just systematic rebalancing, right? It sounds so simple, but if our target asset allocation is 70% stocks, 30% bonds, well, markets move. So if we rebalance today, by tomorrow, it's not perfectly 70-30 anymore. And that's okay, right? If it's 0.01% difference, it's not a big deal. But what happens when markets are extremely volatile? Or on the other side, and I shouldn't say just volatile because there can be volatility to the upside, but what if there's volatility to both the upside and downside? Well, now we're 75, 77% equity and less fixed income. So now our portfolio is more aggressive than we thought it was. On the flip side, when markets fall, maybe we only own 65% stocks and more bonds, so we're less aggressive. Well, what you can do is you can rebalance your portfolio at certain intervals, and if you're within or outside of certain thresholds, maybe you don't rebalance every 1 or 2%, but if it moves 5%, we're willing to take it back to the original target. And what does that do psychologically and both at the fundamental level of your portfolio? Well, what that does is you are buying high and you're selling low. You are selling the thing that just appreciated and you're buying the thing that has dropped in value, at least relative to the other asset class. Buying high and selling low, it's the name of the game, right? It's what we always try to do. But just systematic rebalancing is so important. As part of our strategy changes and part of our process, we do systematic rebalancing because it just takes advantage of small changes in markets, and we're rebalancing back and taking advantage of the buy high, sell low mentality. So those are things that we wanted to share from a perspective with equities being a long-term game, with markets being much more attractively valued, how markets look when market sentiment hits levels that we've seen. Historically, it's been a better buying opportunity than waiting until things feel better, right? Because typically when things are feeling the worst, they've probably reflected that in the price and you're getting in at a much better value. And also, don't look at it like we're just keeping a long-term perspective and doing nothing. We need to be proactive with our portfolios. We need to loss harvest. We need to rebalance. All of these things can happen and should happen during volatile markets. So I hope this was helpful to give some perspective and some silver lining as to the way in which we look at portfolio management, during volatile times, right? But these are just fundamental beliefs, both during good and bad times. If you have any questions, don't hesitate to reach out to us. We're always here, and we always appreciate the trust you put in Diversified. For everybody here at Diversified, my name is Mike Horwath. Thank you for tuning in, and we'll talk to you soon. Take care.